Time could be running out for distressed banks, as a federal lifeline has recently expired. Now, revelations emerge that regulators may be scrambling behind the scenes to make at-risk banks safer. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe, and we'll keep you in the know. Last year, Silicon Valley Bank, Signature Bank, and First Republic Bank collapsed when surging interest rates triggered massive losses to each of their bond portfolios, compromising the bank's financial stability. However, despite the enormous number of banks rendered technically insolvent by rate pressures, we haven't seen the wave of failures many had feared. One reason for that was the creation of the Bank Term Funding Program, an emergency lifeline created by the Federal Reserve, enabling banks to borrow against the full maturity value of their underwater bonds. But the BTFP was recently shut down. Analysts say the program's demise has left at-risk banks in the lurch and scrambling for crucial funding sources. This reality, along with the fact that such a program was deemed necessary in the first place, may confirm just how fragile much of the banking system could be. New research reveals that there are close to 300 regional and community lenders with significant levels of exposure to both distressed commercial real estate and unrealized losses in their bond holdings. This, according to Claros Group, a consulting firm that specializes in regulatory issues and risk management. Brian Graham, co-founder of Claros, says he's aware that regulators are discreetly pressuring banks of concern to shore up capital levels and staffing, underscoring both the daunting task faced by regulators in keeping at-risk banks in line as well as the possible stakes to the financial system if they fail. Graham said, "If there were just 10 banks that were in trouble, they would have all been taken down and dealt with. When you've got hundreds of banks facing these challenges, the regulators have to walk a bit of a tightrope." Banks and regulators may be walking that tightrope for quite a while. Recent economic data came in hot, casting doubts on whether or not we'll see rate cuts anytime soon, putting pressure both on banks and regulators. The CEO of RXR, a multi-dimensional commercial real estate company based in New York City, recently said, "I think there's going to be 500 or more fewer banks in the U.S. over the next 2 years. I'm not saying they're all going to fail, but they're going to be forced into consolidation if they don't fail." Putting an exclamation point on these disturbing assessments is news last week that Philadelphia-based Republic First Bank had collapsed. A financial institution that saw its $96 million in equity overwhelmed by $262 million in unrealized bond portfolio losses. Amid the current landscape, Joseph Liniak, a recognized expert on bank failure, sees the demise of Republic First as a sign of more trouble to come, saying, "This bank failure indicates that additional failures will occur and will range between smaller community banks and larger banks." Uncertainty over the true condition of the financial system is just one component of a broader uncertainty that analysts have come to define the global economy. Many investors, including professional asset managers and even central banks, have turned to traditional stores of value, such as precious metals, to help hedge against the multitude of risks that serve as the building blocks of uncertainty. We hear from people all the time that they are concerned about the true condition of the banking system. It is a key driver to why people want gold and silver. That, along with the global economic uncertainty, we could see gold and silver doing well for quite a while. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.